let's see, Ms. Rominger, I wanted to ask you a question, and it would be about the oversight of private funds, of just thinking about the problems that the financial system went through. These funds did not seem to play a role in the financial crisis, and they certainly didn't receive any bailouts. And they tend to be much smaller in size. And from the testimony we've got, they don't have the kind of leverage that the other financial institutions had. And so, despite all these factors, Dodd-Frank mandates registration for them with the SEC. And I was going to ask, what concrete steps has the SEC taken to ensure it has the capability to adequately oversee these funds? And I was doing so in light of some of the things we heard from Mr. Markopoulos. And what he really drove home with us was that much of the people within the SEC that he had encountered over the many years that he kept bringing this problem to the SEC, this Bernie Madoff problem, he said they just, failed to grasp a relatively simple fraud, basic little Ponzi scheme. And this is a part of the market that the agency has very little experience with now when we start talking about this, the question of private funds. Is this going to be like it was with the SEC when they didn't have portfolio managers? They didn't have people that really could comprehend the kinds of frauds that they were supposed to look into. The SEC has been tasked with overseeing this now, and I wanted to ask you about that.
Thank you, Congressman. That's an excellent question because, of course, in the private fund arena, there is a vast range, both in terms of the size of those funds and
right.
their assets under management, their investment strategies, and the embedded complexity of those strategies, and the way that the rules have been proposed really scales the requirements to acknowledge that, and to acknowledge that the information that it's appropriate to request from a very small or very straightforward, relatively small or straightforward strategy is very different than what should be requested from a larger or more complex strategy that, logically could be more pertinent to the issue of systemic risk. So that scalability, I think, is a feature that attempts to get at what I think is the concern about requiring something beyond that goes beyond what's necessary.
Thank you. I was going to ask Mr. Cook a quick question too, and this goes to the Section 913 of Dodd-Frank, which requires the SEC to study the effectiveness of current standards of care for broker-dealers and investment advisors. In January, the SEC released the study, and that recommended the adoption of a uniform fiduciary duty standard for broker-dealers and investment advisors that would harmonize the differing standards that are out there currently. And can you point to any economic research or empirical data or economic analysis that shows for the need of this harmonization? And what benefit does a fiduciary standard provide that could not be provided by simply improving disclosures so all parties understand who they're dealing with and what they can expect from either their investment advisor or broker-dealer?
Well, Congressman, I think that there have been studies to show that investors are confused about the nature of the relationship that they have with different sorts of providers. And so one of the rationales for doing this would be so that when an investor walks into an investment advisor or to a broker-dealer, that they would not have to become an expert in the various regimes that apply. I think going forward, we certainly will need to think about, as we implement this, the nature of the two regimes, how they apply to different types of financial intermediaries, and how we can best tailor this fiduciary duty and the harmonization of duties beyond that to the different sorts of business models.
Thank you, Mr. Chairman. I'm out of time.